Bitcoin either goes to zero over the long term, or it becomes like a global store value, and it's worth millions, if not tens of millions of dollars a coin, right? In some, long run end state.
Welcome to the Be in Crypto podcast. On our episode today, we will be discussing BitBonds or Bitcoin-infused Treasury Bonds. Today, I am pleased to welcome Matthew Pines, Executive Director at the Bitcoin Policy Institute in Washington, D.C. He's the co-author of an in-depth policy brief on this very topic. Let's dive right in with the basics. What are BitBonds, and why do you propose that they allow the U.S. government to refinance trillions of dollars in government debt at more favorable rates?
Yeah, so it's a really interesting policy proposal that we put together with a co-author, Andrew Hones, who's an expert in kind of structured credit and sort of financial engineering, essentially, in traditional debt markets, and really adapting his expertise to this idea of a BitBond, a Bitcoin-infused debt instrument, and particularly framing that for the federal government in terms of how they might approach a pilot issuance of a U.S. Treasury security with Bitcoin integrated into its maturity profile and its payoff to the buyers of the bond. So that's kind of we had this idea. It's been floating around in kind of the Bitcoin world for some time, but it was kind of a more of a meme, I would say. And so back in March at our Bitcoin for America summit in DC, Andrew gave a presentation to the audience, which were sort of policy experts, folks inside sort of the Beltway, on this idea. And I think it garnered a lot of attention. It certainly seemed to capture the moment. And so we worked with him to kind of flesh it out even further into this white paper. And the context for this particular policy proposal is the U.S. government kind of shifting its orientation towards digital assets in general, and Bitcoin in particular, with the Trump administration coming into office and signing an executive order very, very early on, establishing a strategic Bitcoin reserve, essentially committing not to sell the Bitcoin that it already holds in its possession, and then directing the Treasury Secretary and the Commerce Secretary to identify, quote, budget neutral ways of acquiring additional Bitcoin for the SBR at no marginal cost to the taxpayer. And so there's now an SBR, at least established in name. Formally, it hasn't been stood up inside the Treasury Department yet, although that's coming soon. And the mandate has gone out to those agencies to come up with ideas for how they could add Bitcoin to the national holdings without taking away from any sort of existing programs, right? That are already funded by the government through congressional appropriations. And so the idea of a BitBond is a potential way of adding Bitcoin to the SBR without taking away from additional government sort of services, right? There's no kind of cutting from Medicare to fund the SBR. That's certainly not politically sort of palatable. And do it in a way that actually saves taxpayer, burden over the long term. So that was kind of the idea. The basics of the proposal that we put together, and you can sort of fine tune the numbers. We sort of used kind of a notional description to kind of lay out how it might work. Is the U.S. government issues lots of debt. As anyone that might be monitoring the fiscal situation, we run structural fiscal deficits, really, as far as the eye can see now, $1.5 trillion, probably, maybe more on an annualized basis. And so the government essentially is issuing these securities into the market, and they have different durations. So there's some that are very short-term duration, 3-month sort of treasury bills. Those are seen by the market as very good collateral, almost like cash. And so those have a very strong demand. The further you go out on the treasury curve, the less cash-like those securities are, and the more illiquid those markets are. And so the government has to find a clearing price for the bond and then an interest rate that it has to offer in order to attract demand. And so the 10-year bond right now is about I think 4.3% 30 years a bit higher than that. Those are pretty high interest rates historically, especially given the fiscal deficit that's been adding up on the national debt over many years. The government has to refinance a huge chunk of debt over the next few years that it has issued at short durations over the course of the COVID years at very low interest rates. And if they issue new debt in the prevailing interest rate environment, they'll lock in a much higher sort of interest burden for future taxpayers. And so if there is a potential way of increasing demand for U.S. debt that reduces the interest rate the government has to pay, well, that would save a substantial potential amount of money. And so what could you do that would, increase demand for, say, 10-year bond, otherwise than what's, coming to the government from the market? Bitcoin, right? So this is the idea. Bitcoin, historically has had a pretty volatile but very positive appreciation. And so there was a way of kind of structuring a security instrument that takes some of the kind of fixed income, low volatility, low risk aspects of a traditional bond, especially a government issued bond, and sort of integrating in a little bit, not all, but a little bit of kind of the high volatility, high return aspects of Bitcoin as an asset. And now that the government has explicitly said in its executive order that it believes Bitcoin to be a strategic asset of fixed supply, essentially digital gold for the 21st century, and that they intend to hold what they have and actually accumulate additional Bitcoin as long as it doesn't impose a burden on the taxpayer. Well, that's a direct, instruction, right, to the Treasury Department to identify potential means to do so. And so the basic idea of a bit bond, say you have a 10-year bond, so it pays out over 10 years to maturity. There's a certain interest rate that the government has to pay to the buyers of that bond. If you had an element of that bond where essentially the government sells, say, $1 billion worth of that 10-year bond, and it takes, say, 10% of the proceeds, right? That would otherwise go to fund government operations. It takes 10% off the top, and it puts half of that into the government's strategic Bitcoin reserve to hold indefinitely, right? This is now essentially, $50 million that goes into the SBR. And then the other $50 million essentially gets held in an escrow account and is used to pay out essentially a certain amount of Bitcoin over the lifetime of the bond to the buyers of the bond. And so you're basically buying a sort of guaranteed distribution of a fixed amount of Bitcoin over the life of the bond. And the way that we sort of structured is that the buyer of the bond can be sort of protected from Bitcoin downside, sort of up to what they would otherwise get from buying a normal sort of treasury bond at, say, 4.3%. So you would get the equivalent of the fiat dollars that you would otherwise get up to, say, the equivalent, 4.3% sort of interest rate. And then the upside is sort of shared half to the government, half to the buyer of the bond. And you could change that. You could have it be all to the buyer of the bond, all to the government, 60-40, however you want. We said, for simplicity's sake, 50-50. So half of the proceeds up front go to the government, half go into an escrow account, and then half of the gains above what would otherwise be kind of a normal vanilla 4-point-some% 10-year note go to the holders of the bond and to the government. And so this is a way of essentially, putting some amount of the high volatility, high return aspects of Bitcoin into the return profile of U.S. Treasury debt. And so we've seen some examples of this, issued by sort of corporate borrowers, where, say, MicroStrategy, as an example, has issued a variety of different debt instruments that have a sort of an integrated Bitcoin component into a normal sort of corporate debt offering or a convertible security. And there seems to be a huge amount of demand. In fact, some of these bonds they've issued essentially have a zero coupon, meaning there's like zero interest rate. Now, I don't know what the government will be able to get that, but there's a plausible, and Andrew Hones would be a buyer of such a bond, and he said he would probably, take such a bond down at where it's 2 to 3%. Sort of interest rate. So if the government could issue 10-year bonds and instead of paying, 4-point-some%, could pay 2 or 3-point-some%, that interest savings over the lifetime of the bond could be in the, if it's a $1 billion bond, it could be in the tens, if not hundreds of millions of dollars. And if you scale the program up, the savings could be in the tens, if not hundreds of billions of dollars. And so we recommend the government sort of seriously explore this idea, start small with like a pilot program, sort of test the market, sort of see, how it would trade in both the on the run and the off the run, talk to the dealers, educate, send a very, strategic signal. This is not meant to, upset the normal treasury market. It's a sort of a pilot program, and then see how successful it can be over time. That's the basic idea, kind of a win-win. And it's even better if you can make it tax advantaged, right? So if lots of people want to hold government bonds in sort of tax advantaged ways, if the government were to issue it in a tax advantaged structure, that would probably dramatically increase the demand even more. And so that's kind of the proposal. It's certainly being talked about. I think, there's a lot of work that the Treasury Department would have to do to kind of study the mechanics of this. But now it's on the table. It's an interesting idea that we want folks to look at.
Yeah, absolutely. The core of the issue is the ballooning debt that the US government is currently facing. Why do you propose that BitBonds are the best financial tool to tackle this issue? Why can't we just, for example, cut down on spending and increase production?
I mean, if we lived in a perfect world, right, the government would be able to balance its budget and we'd be able to politically adjudicate the hard trade-offs associated with, cutting government programs, which politically is not very palatable. And so you either grow government revenues, relative to the economy, and that sometimes can crowd out, private sector investment, and sort of banking on a productivity miracle. But even in times of, relatively high strength, the government rarely collects more than 20% of GDP in tax receipts. There's just kind of like a natural cap to what they can do. And, as Lynn Alden says, like nothing stops this train. Like we're in a pretty good economy right now, right? We have pretty low employment, moderate inflation, and yet the government's fiscal position is as if we were sort of fighting a war. It's almost back to like COVID levels. And so that's a sign of like a fundamental pathology in the structure of the federal government's balance sheet. And so maybe we can hope that Washington will, get smart and be able to make these very, very difficult political decisions. But even that, it takes years for those sort of small percentage point changes to like accrue. We might not have that much time, right, before we run into a real issue in the bond market. I mean, there was an episode after the Liberation Day tariff announcements where the 30-year bond like just started getting crazy, right? It was like not just the absolute, rate that was approaching 5%, but the volatility in the bond market was getting out of hand. And the volatility kind of is called the MOVE index. That's like a red alert for policymakers at the Fed and the Treasury that the financial system can break. So we have a very fragile bond market, very fragile, debt situation. And we're in a geopolitical environment where like our adversaries, China in particular, have a lot of leverage over our supply chains, rare earths, et cetera. And they can, whipsaw our inflation through supply chain issues. They can, and they've now climbed the value chain in terms of manufacturing competitiveness. And so we're in a very difficult spot to manage both the strategic competition with our geopolitical rivals, as well as get our fiscal house in order. And so I think you need to we're at the point where we have to like think about non-traditional ways to kind of, help us. And, Bitcoin is one of these ideas that I think a few years ago, this would have been laughed out of the room. But now the government has decided Bitcoin is a strategic asset to hold. Okay, well, just holding it, helps the national balance sheet in some capacity, right? It's a fixed supply asset in an environment where we're going to be monetizing and kind of devaluing currencies and essentially trying to anesthetize the global bond markets. Hard assets are going to appreciate in that environment. That's just what's going to happen. That's what historically always happens. So gold and Bitcoin are kind of the two hardest assets in the global monetary system. Gold is on its way to being remonetized. It's just become the second most held asset in central bank reserves. Bitcoin is about 10% of gold's total kind of market cap. It's not. And Bitcoin is a much more volatile asset, so it can go up and down a lot more than gold, but it also has this tendency to move pretty quickly when it does move. And so if it does, is a reasonable scenario where Bitcoin monetizes to some meaningful level approaching gold, which would have strategic implications. If the U.S. government has it on its balance sheet, it's kind of a really low-cost sort of insurance option. That's just for the SBR. And so if it can integrate that into its bond market, well, then you kind of have this win-win where there's a complementarity between Bitcoin's appreciation as a hard asset in a global environment where most sort of fiats are going to be devalued. But if you can kind of structurally wed that appreciating asset to kind of a fragile fiat debt market, especially one that underpins your strategic investment in defense and your security umbrella for your allies, it can kind of reinforce your global position. So China is sort of doubling down on gold and central bank digital currencies. The U.S. can sort of double down on Bitcoin and dollar-based stablecoins, right? As kind of the freedom, Western sort of version of what the Eurasian autocrats are trying to do. And I think finding the ways of kind of cleverly and deliberately integrating Bitcoin into the bond market could dramatically change, the long-term fiscal health of the country, right? I think if Bitcoin continues to do what it does, if it were to monetize to some meaningful level approaching gold, and the government had this sort of BitBonds program up and running, I think a meaningful proportion of the U.S. government's sort of fiscal position could be resolved. And it seems like a bit of like a one weird trick or too good to be true true kind of thing. But if you look at the numbers, it's we're talking several trillions of dollars, even in kind of a relatively conservative projection. And so it's not like a crazy idea anymore, right? Like we're talking numbers now that actually you can pencil out and think about different scenarios for. Is it a guarantee? No. Is there risk? Right. That's how you structure who bears the risk, how much of the risk is borne by the government, how much of it is borne by the buyer of the bond. You can dial those knobs, right, depending on what you think politically or what you think the government wants to do. So you could put it all on the buyer of the bond, where the government doesn't get as much upside, or the government could take a little bit of the risk and get much more of the upside. And so this is a sort of a free parameter here. But if the government really wants to get the most bang for the buck, one of the things the government can do that almost no issuer of debt can otherwise do is if it buys Bitcoin as a part of this debt issuance, Bitcoin's going to go up. And if it already has it as part of its bond, it can actually generate the reflexivity that almost no other issuer can do. Like Saylor at MicroStrategy can try to do this, right? He's getting to the point now where his like $82 billion of sort of programmatic buys across these different securities offerings are enough to potentially move the market, meaningfully and generate a flywheel. But that's like, it took a lot of work for Saylor to kind of engineer that type of flywheel. And even then it's not maybe, going to move Bitcoin to the strategic level that the US government could do if it just decided this is what we want to do. So yeah, I think it's a bit, certainly outside the box. I think most folks weren't traditionally thinking about this as the solution to the debt problem. But if you just take a close look at the numbers and, run the scenarios where Bitcoin can be a meaningful, ballast in the government's balance sheet.
Yeah, and you mentioned a good point. That's a great transitioner, the point of Bitcoin volatility risk. So I wanted to propose a scenario for you. Say the US starts issuing these BitBonds and I decide to buy one. So I start getting 10% exposure to Bitcoin. At the same time, the price of Bitcoin suddenly drops, say, from 110,000 to 73,000. What happens to my return in a scenario like this one?
Well, you're buying a bond that has a fixed amount of Bitcoin that pays out in Bitcoin terms, right? And so if you're valuing the bond in Bitcoin terms, nothing has changed. If you're valuing it in US dollar terms, well, then the present value of the bond goes down. Right. So if you didn't want to hold it to maturity, if you were sort of a speculative investor, you wanted to buy the bond and be able to sell it to somebody else. Well, that other person that you might want to sell that bond to is going to require a discount to what you paid for it. Because when you paid for it, you were valuing that Bitcoin at, say, 100,000 US dollar, equivalents. And so each, unit of Bitcoin that gets pays out over the lifetime of the bond, you sort of your net present value is based on that projection. So it would trade at a discount. So if you're holding the bond, it's like with any other bond, right? Like the interest rate goes up, the price of the bond goes down. If you intend to sell the bond, right, because you're a speculative investor and you want to trade the security, well, you're gonna take a loss if you sell the bond when the interest rate is higher. It's going to be But if you hold the bond to maturity, nothing happens. Right, you still are guaranteed that fixed amount of Bitcoin over the lifetime of the bond. And so it's a difference in terms of who might try to buy the bond and what's their risk appetite, right? There's lots of fixed income instruments that provide savers, essentially, guaranteed payouts, right? And that's what you want as a retiree, right? So if that's your sort of risk profile, you'll have a guaranteed amount of Bitcoin come to you, right? And whatever that dollar price is what you will get, right? In terms of how you consider the value of dollars versus Bitcoin. If you're looking to consume, you probably want to sell that Bitcoin to hold and to then use dollars to fund your lifestyle. If you just wanted to get the Bitcoin to hold the Bitcoin, well, a lot of the buyers of this bond, at least my assumption, are going to buy it to hold the Bitcoin, right? And it's kind of, the thesis is that there are people out there that want to have access to a fixed income instrument that is sort of backed by the full faith and credit of the United States that gives them exposure to Bitcoin without, the full exposure to, just buying spot Bitcoin, right? With a lot of volatility. Now you could construct maybe a similar profile, but if you were a sophisticated investor and you could go into the options market and you could kind of hedge, right? If you had a bunch of spot Bitcoin and you want to hedge it to get to sort of emulate the risk profile of this bond, you could probably engineer something like that. But that's not something that most casual investors can do. And it's really not in the mandate for a lot of potential buyers of this bond to do, right? Where there's lots of fixed income pools of capital that can only buy fixed income instruments. And so they can't do options trading, they can't buy spot Bitcoin. And so this instrument would give them access to basically the same sort of, hedged, return profile. And it's the only way they could get access to something like that. And so, yeah, so it certainly wouldn't be for everyone, right? It'd be a certain type of investor. And I think the thesis is that there's a pretty large pool of capital between fixed income as well as sort of Bitcoiners that would want to have, essentially government security that's, has very low default risk, right? You can buy, something similar from MicroStrategy, but you've got exposure to MicroStrategy and you've got key person risk with Michael Saylor. You've got, a lot of operational risk associated with MicroStrategy, the company. You've got the custody risk associated with MicroStrategy's, custodian. The government, presumably would have much lower risks on all those different dimensions. And so if you had the choice, you'd probably buy something like the government's instrument. And so, yeah, there's no thing as a free lunch, right, in this world. But I think there's a meaningful proportion of capital that would be interested in buying it. And I think the government would have to be deliberate about starting small, testing the market, see what the clearing rate is, seeing what the secondary market looks like. And, ultimately, it is a bet that Bitcoin will continue to go up over time. But the way you can structure it, the way we structure it, is essentially that downside risk is capped, right, at essentially the equivalent of buying a normal bond, right? And so, worst case scenario, you just get what an otherwise normal 10-year Treasury security is, right? And so you don't get the gains you thought you were going to get from Bitcoin because Bitcoin didn't do anything. But that's the financial market.
Absolutely. So I'm assuming that a program like this would involve the purchase of large quantities of Bitcoin. How would this acquisition impact market prices, for example?
Yeah, so depending on how you scale it, right? We have kind of a pilot program. You could start with, say, $10 billion. If you took 10% of that, and used it to fund the SBR and then the escrow account for the buyers of the bond, that's $1 billion of sort of buying pressure. That's a meaningful amount of buying pressure. I would say, not an expert in the market structure at the moment. The government could probably find ways of doing it without, dramatically impacting the price, but it would certainly add to the buying pressure. It would likely appreciate the price, somewhat. But I think, we have announcements by Bitcoin treasury companies almost every week or two now that hasn't yet hit the market, but announcements of capital raises in the billions of dollars, right? Between Nakamoto, 21, Metaplanet, there's, and obviously MicroStrategy. So there's already a lot of, I'd say, billions of dollars of buying pressure out in the market coming from, these sorts of treasury companies. I think U.S. government doing it, it would probably be less the buying pressure that would move the market. It would really be the endorsement of the government saying they're going to do such a thing. That would probably change future expectations of Bitcoin's price dramatically, much more than the actual $1 billion of purchases, right? Because it would then, the average, participant in the market is sort of pricing almost like two binary outcomes for Bitcoin over the long term. Bitcoin either goes to zero over the long term, or it becomes like a global store value and it's worth millions, if not tens of billions of dollars a coin, right? In some, long run end state. And so the market at any given moment is sort of pricing those two end states, right? I think almost nobody in the market actually believes in, say, 50 years, Bitcoin will be worth like $200,000 or $100,000, right? It'll either be worth a lot more than it's worth now, or it'll be worth almost nothing, right? It'll have failed for some reason, right? That's, and the market is discounting, between those two different scenarios. And so if the U.S. government were to come in, and it's kind of already done this a bit with the SBR announcement in the executive order, it's, progressively de-risking, one of those scenarios. And that's kind of a nonlinear process, right? When you have kind of this highly skewed distribution, right? The market is kind of constantly trying to assess which one of these very different futures is more likely. The world's most powerful country stating for the record that Bitcoin is a strategic asset and they tend to hold it and maybe acquire more of it and then also integrate into its bond market. I mean, I don't know, as a rational person, I would be like, okay, well, that means numbers are probably going to go up over the long term. What the clearing price is, who knows, right? There could be a lot of volatility along the way. That's one of the things the government can do. The government can move the market, right? And so it has to be deliberate about how it does that, because it would, it would now be a much different force. And that's a broader question that now Bitcoin is having to face, now that Bitcoin's become a geopolitical asset. When it was $100 billion, it's not that significant for countries. When it's $2 trillion and on its way potentially to multiples of that, then it's very much of a strategic, sort of color for central banks, for national finance ministries and heads of government. And that's a process we're going through right now, right? Trump has, stated this, and there was a kind of I'd say an ambiguity in the perception of what that implied. Was this just like a sop to political, supporters in the campaign? He wanted to be pro crypto. He'll sign executive order, pat him on the head, but that's it. Or does this signify like an actual strategic shift from the federal government in its relationship to Bitcoin as an asset over the long term? And I think we still haven't fully resolved which of those two scenarios like we are in. I think it's probably a mix of both. And I think I'm seeing hints that it's more and more leaning towards the latter than the former. Like that's been the trajectory since the election into what we're doing now for our policy summit. Like, for example, I'll be sitting down and having a fireside chat at our Bitcoin Policy Summit on June 25th in DC with the Deputy Director of the Central Intelligence Agency. And then my colleague will be doing a similar fireside chat with the gentleman who runs the Office of Strategic Capital at the Department of Defense, and whose previous job was overseeing all of DARPA advanced research for the Pentagon, and is the sort of deputy for the president's working group on digital assets at the White House. And so here you have individuals that are of significant, stature and sort of national security bona fides coming to a Bitcoin policy summit to talk about the strategic significance of Bitcoin. I think we've come a long way from where we were a year ago. And that sort of, those are hints to me that the ship of state is turning gradually in this direction. And so BitBond is just one idea, right? We've put on the table for how the government could kind of be creative in getting most of the benefits from its pro-Bitcoin strategy. But there's lots of other ideas on the table. And so that's what we'll be talking about in June.
That's really, really interesting. You also mentioned towards the beginning of our conversation this idea of maybe doing a pilot program with BitBonds to see how they perform. Maybe in your encounters with different political figures or different departments, have you seen positive reception from the U.S. government in perhaps contemplating this idea or an implementation of sorts on the topic of BitBonds?
We've had conversations. I know Andrew Hones has also had conversations with folks at the White House and folks in the government on this topic, and they're definitely in like listen and learning mode, right? This is a novel idea. They have complicated bureaucracies. They have very, they're procedural systems, right? Lots of memos and studies and reports and analysis would have to go into anything like this. And I think at the moment where we are in the kind of the timeline is post the executive order, those agencies, specifically Commerce and Treasury, have to identify like, the menu of options for budget neutral acquisition of Bitcoin. And then they have to write this big report that's due July 22nd. That's kind of like going to be like the summary statement from the administration about how they view digital assets in general. And that will include analysis of the logic behind the strategic Bitcoin reserve and means of adding to the government's holdings. And so there may be a mention of BitBonds in that report. That would probably be the most I'd say optimistic next sort of milestone would be if they even mention it. I hadn't seen anything that would indicate they will, but that would be surprising, but not implausible that they could mention it as an idea that they were exploring as part of this menu of options. And then it's kind of the government moves slowly, right? And then it's okay, well, there's got to be some memo written inside the Treasury Department to, the office that manages debt issuance. And those are a bunch of civil servants, some might say bureaucrats, that wouldn't necessarily be inclined to do something too novel, right? Like the U.S. government is very conservative in how it approaches debt issuance. They're very sensitive to the market, so they'd want to be very deliberative in how they signal this. Like they tested 20-year bonds, and they spent like 2 years just like studying the market mechanics to see, is there like a little bit of friction? Are they saving 20 basis points or losing 20 basis points on the curve by adding this tenor? And they're and all these things like treasury buybacks are all about sort of trying to like do the little mini twists in the curve where they try to sell short dated, buy long dated things to kind of make add a slightly more liquidity into the markets, shaving off little bits and pieces. So they're very slow. They're very like incremental in how they approach the debt issuance. And so this idea, honestly, probably breaks the brains of everyone in that office. Right? That's like, spend months just doing like the basic analysis of a slight adjustment to how they issue a debt. So this idea of doing is a very bold idea. This is not something I think they would just be like, oh yeah, let's do that. It'll take a lot of convincing. And I think we're at this point where when everything seems fine, relatively, the urgency to do something kind of somewhat outside the box isn't really there. But I think the logic behind DPI putting this policy proposal on the table is having it, be in the water long enough that it's familiarized with enough of the policymakers and the bureaucrats that if there ever is an exigency or a political urgency to do something quite dramatic, this option is already there. It's been thought through, right? And so I don't expect them to just be like, well, yeah, we're going to roll out BitBonds in 2026. I think they have to be forced to do something, right? Like that they don't want to do, right? And either politically, they have to get instructed by the government, the White House, to do it, which could happen, or the market basically says, you got to try something else because what you're doing isn't working, and so you're gonna have to keep borrowing at a more expensive cost. And so that then is either forces austerity, which nobody likes, or basically quantitative easing, right? The government has to print money to buy the bonds. And so if we get to this point, where the government has been historically of, like there isn't enough buyers out there for our debt because of some financial crisis or market structure issue, like we saw in 2008 and again during COVID in 2020, then all of a sudden, like, it's like everything is on the table, right? Like the Federal Reserve just like bought everything in 2020. Like they did trillions of dollars in QE in 3 weeks, and they bought mortgages and credit card debt and corporate debt. They were just buying everything. And that led to and then we did lots of stimulus. There was lots of inflation. So clearly, like when you're in an emergency, ideas are executed that maybe you wouldn't have thought about in peacetime. Those ideas sometimes have a lot of second order consequences and costs. And I mean, this is another idea that maybe wouldn't be the first thing you do now, but would be a smart thing to do. And if you do it, incrementally before a crisis, could actually give you more options in a crisis. So that's kind of the thing. Is like we're in a pretty difficult spot. The government doesn't often think long term. This is a way to kind of build in a bit of an asymmetric insurance option for it. And we'll have to see if these policymakers take it up. But I think we're just gonna keep talking about it and educate. And if folks have questions about it, and we saw the New York City government, right? Mayor Adams come to the conference in Vegas and essentially announce something like that they would explore a New York City bit bond, similar idea. I think that's very much contingent on the results of the New York City mayor election, which who knows? But the fact that you have another mayor, right, of the largest city in America, saying the term bit bonds. Now the mayors of Philadelphia, the mayors of Miami are like, oh. Or the mayors of Amarillo, or they're like mayors of small town Fort Worth, Texas. Like, everyone's going, oh, is this it? Could I do this? Right? Could I issue something like this for and it actually might even be better for state and local governments because they can't print money. The government can always print the money, right? As I just said, it does have costs, but at the end of the day, the government can always just like print the money and have its debt bought, right? But the mayor of New York, the mayor of Miami, like doesn't have money printer, and so they actually have more constraints. And so they probably actually give more of a reason to explore BitBonds. So I think we might see more experimentation come from the state and local level before you get, say, the Treasury Department, right? Kind of sort of leading the charge here. But now that it's out there, people are going to talk about it. And mayors and political leaders on the frontier will, there's a first mover advantage, there's first mover risk. But if you're the first one to do this successfully and all of a sudden, you can tap a market and you can borrow much more cheaply, and you can fund you can fund government programs without burdening taxpayers. I think the average taxpayer would be like, I don't know about this whole Bitcoin thing, but if that means my taxes go down or I get better parks and schools and police, okay, seems like a good idea. And so that's smart mayors that are willing to kind of stick their neck out. Potentially, they'll be the kind of the crucible of innovation here.
Well, this has been a really insightful conversation, Matthew. You've been really generous with your time. I really appreciate it. We'll definitely be keeping a close eye on how the conversation on this financial instrument develops on all fronts. Thank you so much for joining us today. Hope to have you back again soon.
Thanks for having me.